In part one, we discussed the problem. A typical high earner portfolio stuck in three traps. Cash with no job, assets in the wrong tax wrappers, a portfolio so fragmented you can't describe it in one sentence. Today, we fix all three. With a simple system you can set up once and maintain in 20 minutes per quarter. I'll show you the same logic that I use in my portfolio that I have had to learn and adapt and deploy in real time. Let's start with the easiest win. You don't have a cash problem. You have cash without a job. Step one, calculate your essential monthly spending. Mortgage or rent, bills, food, transport. For most high earners, this lands somewhere between £3,000 to £6,000 a month. Step two, multiply that by 6. That is your emergency fund. Put that amount in an easy access savings account and forget about it. That's bucket one. Step three, identify the real goals that you want in the next 1 to 5 years. Moving house, school fees, a career break, ring fence that money. That is bucket two. Everything else gets invested. That is bucket three. Every pound and dollar sitting in bucket three as cash is drag tax. It feels safe, but it quietly loses its purchasing power. If the market fell 20% tomorrow, would you regret investing or would you regret leaving money in cash for another year? That answer usually tells you which bucket the money really belongs in. The common objection to this is timing. But what if the market drops right after I invest? I have two responses. First, if your horizon is 10 years or more, the data shows time and time again that time matters far less than people think. Secondly, if it genuinely bothers you, just use dollar cost averaging. Move a fixed amount every month over 6 to 12 months. The point isn't that you should be perfect, but the point is that you want to remove decisions and you want to make sure that every pound or dollar has been assigned a job and every job has a known timeline. Now let's fix the tax drag. This is where people overcomplicate things. You only need one principle. Put your highest growing assets inside the most efficient tax wrapper. That's it. Everything else is detail. Here's your tax wrapper hierarchy. Your first priority is your ISA. In the UK, we're allowed to put £20,000 per year into our ISAs. Everything inside your ISA grows tax-free. No capital gains tax, no dividends tax, and no income tax. This is where you put your highest growth assets. Equities or stocks that you expect to compound for decades. Depending on your situation, you may have a SIP or a self-invested pension plan. Here you receive the tax relief upfront, 40 or 45% for many high earners. And the growth inside is tax-free as well. But here's where it's different from the ISA. Any withdrawals are taxed as income. So this wrapper often works well for income-producing assets. So these could be your bonds, dividend strategies, or anything that generates a yield. But also remember that you can only withdraw it after 55. The third one is your general investment account. That is fully taxable. Here you want to have your most tax-efficient holdings, broad accumulation ETFs, and assets where distributions are minimal. Look at all your accounts and ask one question. Why is this asset in this particular investment wrapper? If the answer is just that's where I bought it when I found out about it, you're probably paying tax that you didn't need to. The rule is simple. Don't let habit decide where assets live. It can feel overwhelming or cumbersome. I recently had to move a SIP and it was so painful, but it just meant that my portfolio was too fragmented. You should really let tax logic decide where your assets live. And for high earners, inefficient tax placement alone can reduce your long-term returns by roughly 1% a year, which may not sound like a lot, but compounds to about 20 to 25% of your wealth over 20 years. Now, the big fix, the one that you might be putting off, and this is where most high earners struggle. Instead of having a bunch of random holdings, you collect everything together and build your investment around intentional pillars. Fixing your fragmentation and bringing everything into one pot is often the ideal time to do it. It allows you to give each pillar a proper job, and each job has a clear logic for why it sits in your investment portfolio. Putting that all together gives you something which is much more powerful than the fragmented portfolio you had before. You can explain your portfolio in one sentence. So here's exactly how I think about it. My portfolio is built around a small number of structural themes. Each one is chosen because I believe it has a multi-year tailwind. I'm not going to list every position here. You can see it on my public portfolio because positions tend to change, but the architecture of the portfolio stays the same. Pillar 1, quality growth. This is the core of my portfolio. Companies that have strong balance sheets, pricing power, and long-term growth. The second pillar, structural themes, industries that have long-term tailwinds. And right now, that includes defense, aerospace, energy transition, and sectors where government policy creates persistent demand. These cycles last years, not quarters. The third pillar, real assets. Gold, silver, commodity producers. And this is my portfolio insurance. When my growth assets fall, this pillar often stabilizes the portfolio. Pillar 4, the bond ladder. Short duration, medium duration, and long duration. They have 3 roles: income, lower volatility, and they allow me to rebalance capital. So when equities fall sharply, high quality bonds often tend to rally, and that gives you something to rebalance from. Pillar 5, quality financials. Strong banks and financial institutions with solid balance sheets. These businesses often perform well when interest rates are high or when macro environments become complex, as they have been. So if a holding doesn't belong to one of my 5 pillars, it simply doesn't belong in the portfolio. It keeps the structure stable even when individual holdings change over time. The final piece makes it sustainable. It's a rebalancing schedule. Certain pillars in the portfolio can outperform, and suddenly one part of it represents half your portfolio. Once a quarter, I run a 20-minute review where I do the following. Check all the pillar weights. If something has grown disproportionately from the target, then I rebalance it. Check my wrapper efficiencies. Has anything in my income changed? Has my tax-free allowance reset? Can anything move to a better tax wrapper? Check the thesis. Not did the price fall, but has the reason for owning it in the portfolio changed? If none of those trigger, then you don't have to do anything. And that's the whole point. Let's recap. First, the cash audit. Every pound has a bucket and every bucket has a timeline. Secondly, the wrapper strategy. Tax-free savings account first, pension second, and then your general investment account. Third, the pillar framework. Have an intentional structure instead of random holdings. Rebalance them quarterly. And that's the system. It's not complicated. It's intentionally boring because I have learned the hard way that boring compounds. Episode 1 was the diagnosis. Episode 2 was the treatment plan. But how much difference do you think this actually makes? In episode 3, I'm going to run the numbers. Understanding the system is useful. Seeing what it does to your wealth is what actually makes you use it. So see you in episode 3.